The last time a new Fed chair took the seat, Apple lost 38% in 3 months. The strongest company in the index, down almost 40%. The next one takes over on May 15th. The committee under him is the most divided it's been in 33 years. And Warren Buffett, who's been right more than anyone alive, has spent 3 years stockpiling cash instead of buying anything. So what survives any version of what happens next? In this video, I'll walk you through 5 stocks. They share one rule: the rest of the market is failing right now. Each one stayed profitable through all 3 of Powell's market shocks, and they're built for whatever the next 8 years look like. One is the most direct rate cut bet on the list. One of them just lost $357 billion in a single session, the biggest single-day loss in the company's history. The market got that one wrong. And one doesn't care who runs the Fed at all. And in the end, I'll show you what Buffett's $397 billion war chest is preparing to buy, the one stock that ties this entire video together. Quick context first. The Fed chair runs the committee that sets short-term interest rates in the United States. When the Fed cuts, borrowing gets cheaper across the economy. Mortgages, credit cards, business loans, stocks usually go up. When the Fed hikes, all of that runs the other way. That's the lever. The Fed chair has the biggest hand on it. Jerome Powell has had that hand for the last 8 years. Took over February 2018, survived 3 market shocks under his watch: the volatility spike in early 2018, the COVID crash in 2020, and the rate hike bear market in 2022. Each time stocks got hit, each time they came back. By the end of his term, the S&P 500 returned roughly 14.71% a year. That's the 3rd best run for any Fed chair since 1970. But when Powell first took over, stocks dropped hard. By late 2018, the S&P had fallen close to 20%. And it wasn't just the speculative names. Apple peaked at $58 in October 2018, then fell 38% to $36 by January 2019. Apple alone lost 30% in the 4th quarter of 2018. These were the strongest companies in the index. They still got hit. The difference is which ones came back. Apple, Amazon, Microsoft, all back to new highs within a year. The names that didn't come back, well, those are the ones nobody talks about anymore. Now here's who replaces Powell: Kevin Warsh, Trump's pick. Confirmed out of the Senate Banking Committee on a 13-11 party line vote. Former Fed governor from 2006 to 2011, meaning he was at the Fed during the 2008 financial crisis. He's publicly argued for rate cuts. Takes over on May 15th. But Powell doesn't actually disappear. He's staying on the Fed's board through 2028. And here's the part nobody's talking about. The FOMC, the committee that votes on rate decisions, 12 members total, just had its most divided meeting in 30 years. At Powell's last meeting, 4 of them dissented, the largest split on the panel since 1992. 3 of them thought the Fed was being too soft and shouldn't signal more cuts. Inflation is sitting at 3.2%, the highest level since November 2023. Iran's energy spike is making it worse. So here's the question. What happens to your portfolio if Warsh wants to cut rates and the committee says no? May 15th kicks off a window of regime uncertainty, months where nobody knows exactly what direction rates are going. Uncertainty creates volatility. Volatility creates entry points. The goal is simple: find the stocks that win under any version of what Warsh does next. That's what we're going to do next. Here's the rule they share. Every stock on this list had to thrive through Powell's full 8 years. Not just the headline gain, meaning not just the stock that went up over 8 years. The company had to grow revenue, raise dividends, or in one case raise its book value, and recover to new highs after each of the 3 market shocks. Sounds simple. It cuts almost every stock from being pitched for this transition. Start with the names everyone is talking about right now. Nebius only resumed trading as Nebius in October 2024 after splitting from its Russian predecessor. Never tested through a full Fed cycle. Out. AppLovin only IPO'd in 2021. Never tested through a Fed transition. Out. Applied Digital, public since 2022, deeply unprofitable, can't prove it survives a rate hike cycle. Out. These aren't bad companies. They might be huge in 10 years. The point is they don't fit this list. 3 of the most pitched stocks of 2026 fail the rule before the analysis even starts. The 5 stocks that pass share 3 things. They were profitable in 2018, they're profitable before, and they're profitable now. They raised their dividends, or in one case raised their book value, through every Fed shock Powell threw at them. And they have moats, meaning what makes the business hard to compete with, that don't depend on a specific rate environment. First up is Home Depot. If Warsh cuts rates this year, this stock moves first. Quick context here, because most viewers skip past this part. Mortgage rates aren't the Fed funds rate, meaning when the Fed cuts, your mortgage rate doesn't drop overnight. But Fed cuts pull the whole interest rate curve lower, and mortgage rates follow that curve. Lower mortgage rates means people start buying houses again. People buying houses means people fixing up houses. People fixing up houses means Home Depot. Home Depot did $164.7 billion in sales in fiscal 2025. They've paid 156 consecutive quarterly dividends, meaning they haven't missed a payment in 39 years. Just raised the dividend 1.3% to $9.32 a share annually. Operating margin around 12.4 to 12.6%. ROIC sitting at 25.7%. And that last number basically means the company is good at turning every dollar it puts in into more dollars coming out. Now here's the catch. Q4 sales were down 3.8%. ROIC dropped from 31% to 25%. Tariffs are creating margin pressure. Fiscal 2026 guidance is barely up, 2.5 to 4.5%. This is a company waiting for rates to come down. And that one weakness is the point. 8-year Powell test. Home Depot raised its dividend in every single year of Powell's term, through COVID, through the 2022 bear market, through the housing freeze. Most of the index can't say that. That's the rate cut bet. It works if Warsh delivers, but 3 FOMC members voted against more cuts last meeting. Inflation back above 3%. So what if Warsh can't deliver? That's where stock number 2 comes in. Microsoft. This is what happens when Warsh can't deliver, or when the market just panics about something completely different. This stock just had the largest single-day dollar loss in the history of the company. $357 billion gone in one session. That could be one of the biggest entry points for investors considering buying it. So why did Wall Street panic? Microsoft is spending more money than ever on AI. $37.5 billion in CapEx, capital expenditure, meaning money they're spending now to build something they hope pays off later, in a single quarter. 66% more than the year before. The market freaked out because Microsoft's whole identity has been making lots of money without spending much. Here's the other side. Operating margin still sits above 47%, meaning for every dollar of revenue, Microsoft keeps almost half its profit. That's a 20-year high for the company. Azure, their cloud business, is growing 39% year over year. Commercial RPO backlog hit $625 billion. Quick unpack. RPO basically means contracts already signed but not paid yet. So Microsoft has $625 billion of revenue waiting to come in. That number more than doubled year over year. The capex isn't fear, it's a locked-in demand. Microsoft did $81.3 billion in revenue last quarter, up 17%. Operating income $38.3 billion, up 21%. Non-GAAP EPS of $4.14, up 24%. 8-year Powell test. Microsoft survived 3 Fed cycles: early 2018 volatility, COVID 2020, the 2022 bear market, and hit a new all-time high after each one. The current pullback is a good opportunity to get in. Long-duration tech, meaning companies whose biggest profits are 10+ years out, benefits when rates fall. If Warsh gets even one cut through, Microsoft re-rates higher. If he doesn't, the contracted backlog still compounds. That's 2 ways to win and 1 way to lose. 2 stocks down, 3 to go. And in the end, I'll show you Buffett's $397 billion war chest and what he is preparing to buy. Speaking of war chests, $126 billion in cash, the second largest war chest in corporate America. Only Berkshire has more, and we'll get to that one in a minute. And it belongs to a company you probably already use 100 times a day. Alphabet, the parent company of Google. In case anyone's confused, Alphabet is the company, Google is the brand. Same thing for stock purposes. What it owns? Search, YouTube, Android, Google Cloud, Waymo. The cash is funding the AI infrastructure build-out that will define the next decade. Alphabet did $109.9 billion in revenue last quarter, up 22%. Net income $62.6 billion, up 81%. Cloud revenue grew 63% to $20 billion. Search revenue grew 19%. And that one is important because the headlines that AI is going to kill Google search thesis just got buried. Cloud backlog jumped to $460 billion, almost doubled in a single quarter. Now here's the catch. Capital expenditure guidance raised to $180 to $190 billion for 2026, up from $175 to $185. Management said 2027 will be significantly higher. Alphabet just issued $31.1 billion in senior unsecured notes, meaning they're borrowing money to fund the AI build, not just paying cash. The risk is real. The CapEx bet has to pay off. If it doesn't, the cash fortress shrinks fast. Same long-duration tech tailwind as Microsoft if Warsh cuts, but Alphabet has a second mode. Even if rates stay high, that $126 billion cash earns about 3.67% in T-bills. Quick context. T-bills are short-term U.S. government bonds, basically the safest place to park cash. Two engines, one for cuts, one for no cuts. Now let's have a look at the 8-year Powell test. Alphabet survived 3 Fed cycles under Powell: the early 2018 volatility, the COVID crash, the 2022 bear market, and made new all-time highs after each one. Cloud only existed as a real business by year 3. By year 8, it's a $20 billion a quarter segment growing 63%. That's 3 stocks. 2 of them care a lot about what Warsh does. The next one doesn't care at all. Visa. This is the one that doesn't care. 901 million transactions every single day. That's how many times Visa takes a small cut from the global economy. Every time you swipe a card, tap your phone, buy something online, Visa takes a tiny percentage of that transaction. They don't care if you bought a coffee or a car. They just care that you bought something. Network effect duopoly with MasterCard. Merchants accept Visa because consumers carry it. Consumers carry it because merchants accept it. That makes it basically impossible for a new company to enter this space. Visa's net revenue last quarter was $11.2 billion, up 17%. Strongest growth since 2013, outside the pandemic. Non-GAAP EPS $3.31, up 20%. Payment volume is $3.7 trillion. Processed transactions $66.1 billion. Just bought back $7.9 billion of stock in one quarter, the highest quarterly buyback in Visa's history. New $20 billion authorization on top of that. Here's why Visa is on this list specifically. If Warsh cuts and consumer spending picks up, transaction volume rises and Visa wins. If rates stay high and consumers slow down, e-commerce keeps growing globally and Visa still wins. Visa doesn't care who runs the Fed. It just cares that people keep buying things. PE ratio of about 29, meaning the stock costs 29 times what the company earns in a year. That's a premium. Antitrust pressure on what Visa charges merchants is real. You're paying a premium for the moat, but the moat is paying you back every quarter. As for the 8-year Powell test, when Powell took over, Visa was processing roughly half the daily transaction volume it processes now. 8 years later, it's 901 million transactions a day across $14.2 trillion in annual payments volume. 4 stocks down, each one wins under a specific scenario, and the 5th is the one that ties the whole video together. Remember the $397.4 billion from the start of this video? Time to talk about it. Berkshire Hathaway, Warren Buffett's company, basically the most successful investment vehicle in modern history. But here's what most viewers don't know. Buffett actually stepped down as CEO. Greg Abel, Buffett's hand-picked successor, runs operations now. Q1 2026 was Abel's first quarterly report. Most viewers still think Buffett is at the helm. He's not, and that's part of the story. Berkshire Hathaway holds $397.4 billion in cash and short-term treasuries, largest in Berkshire's history. Here's what most channels skipped. Buffett built most of that cash pile through 2025 by being a net seller of stocks for 13 straight quarters. Abel made it 14 in his first quarter as CEO, meaning every quarter for 3.5 years, Buffett sold more stocks than he bought. He didn't just step down. He handed Abel the largest dry powder position in corporate history. And even Abel's first quarter included another $8 billion of net stock sales, 3 weeks before the Fed transitions. The cash isn't lazy. It's earning roughly 3.67% a year in T-bills. That's about $16 billion a year in interest just sitting there. For context, that's more annual income than McDonald's makes in profit. And it's optionality. If Warsh's transition creates the volatility everyone expects, Berkshire has more buying power than at any point in its history. Buffett prepared for both sides of the trade. Here's the trade-off you have to wrestle with. Every other stock on this list pays you to wait. Home Depot pays $9.32 a year. Microsoft, Alphabet, Visa, all paying. Berkshire pays nothing, never has. Buffett famously refuses to pay a dividend because he thinks he can do more with the cash than shareholders can. You have to decide if you can live with that. The trade-off is real. No income, no dividend reinvestment, no payout track record. What you get instead is the largest war chest in corporate history, deployed by the team Buffett trained for 60 years. Q1 2026 operating earnings up 18% to $11.35 billion. Insurance and conglomerate operations posted strong gains. The conglomerate works regardless. Railroads, utilities, insurance, Geico, the Apple stake, Coca-Cola, Bank of America, American Express, basically a slice of the entire US economy. Now here's the catch. Buffett's mystique is partially gone. Annual meeting attendance dropped sharply this year, the first one without Buffett at the helm. Abel hasn't proven himself yet. You're betting on the system Buffett built, not Buffett himself anymore. Berkshire entered Powell's tenure with about $116 billion in cash. 8 years later, $397.4 billion. Buffett spent the entire Powell era preparing for what comes next. Every other channel is going to tell you what Warsh will do. Berkshire just told you what to do without saying a word. Build the cash, wait for the volatility, buy what works regardless. Now let's put all 5 together. 5 stocks. Home Depot is the rate cut bet. Microsoft and Alphabet are the long duration compounders. Visa is the toll booth that wins regardless. Berkshire is the hedge that wins in the volatility itself. This isn't picking one, it's owning the spread. But there has to be honesty about what kills this thesis. 3 things could break it. A recession. If the economy actually rolls over, every stock takes a hit. Even Visa. Even Berkshire. Though Berkshire takes the smallest hit because it has the most cash to absorb the shock and the most cash to buy the dip. An AI capex bust. If Microsoft and Alphabet's build-out doesn't generate the returns they promised, both stocks re-rate down sharply. The whole thesis on those two gets rewritten. A geopolitical shock. Another Iran-style energy spike forces Warsh to hold rates higher than anyone wants. Home Depot takes the worst of that. Every stock has a weight to lose. The list just makes sure no single scenario kills all 5. If you'd rather skip picking stocks altogether, the video on screen breaks down 3 ETFs projected to crush QQQ in 2026. The best one would put you $6 million ahead. I'll see you there.